Imagine spending months just meticulously drawing a mathematically perfect map of a landscape.
Okay.
You chart every valley, you measure every peak, calculate the safest paths, and then overnight, a massive earthquake strikes.
Oh, wow.
Right? And it simply rearranges the entire continent.
Yeah.
So suddenly, your perfect map is pointing you right off a cliff.
That's a dangerous map.
It is. And that collision, between a perfectly drawn map and a sudden violent shift in reality, that's really the entire theme of our deep dive today.
I love that analogy. It's incredibly fitting for what we're looking at.
Yeah, so we're looking at a snapshot of the Pakistan Stock Exchange, specifically the KSE-100 index, on August 24, 2026.
Right.
And we are cross-referencing two very different sources.
Yeah.
We have a broad technical analysis report, and we're putting that up against a raw, unvarnished corporate financial report for a very specific company.
And the tension between those two things is just, it's phenomenal.
It really is.
Because it's the ultimate real-time test of market philosophy,
That's...
Well, technical analysis, it maps human psychology, right?
Right.
And historical price action.
like the lines on the chart.
Exactly. It assumes that past behavior will dictate future movement.
Right.
But then fundamental analysis, it just ignores the map entirely. It looks at the underlying tectonic plates.
The earthquake stuff.
Exactly. The actual cash flow, the debt, the unarguable reality of a corporate balance sheet.
Yeah.
And when those two forces disagree, the resulting volatility is where, fortunes are either made or completely erased.
Which is terrifying and fascinating.
Yeah.
So to understand that volatility, I feel like we first have to map the current environment.
Absolutely.
We need to take that 30,000-foot view of the KSE-100 index just to see the broader mood of the market.
Yeah, lay out the macro picture for us.
Okay, so as of August 24, the index is sitting at 176,966.68.
Right.
It's down about 200 points for the day, which is a drop of just 0.11%.
Practically flat.
Yeah, and it hit an intraday high of 178,122 before sliding back down. Total volume was over 443 million shares traded.
Which is solid volume.
It is. But on the surface, a 0.11% drop on an index priced at 176,000, it feels entirely uneventful.
Yeah, it's a rounding error, mathematically speaking.
Right.
But that daily movement only matters when you place it in the context of the longer-term trend.
Which is where things get interesting.
Oh, very. Because the data shows a massive one-year change of positive 18.38%.
That's huge for an index.
It's staggering. An 18% gain on an index of this size requires a tremendous amount of capital inflow.
Right.
But the market, it can't sustain a vertical climb indefinitely. It eventually has to digest those gains.
Digress, though.
Yeah, like the buyers need to absorb the profit-taking from the early investors who are cashing out.
Right. The people who got in a year ago are saying, hey, 18% is great. I'm taking my money.
Exactly. And that digestion process is clearly visible in the 4-hour chart.
Yeah, the technical report notes a correction from an early August peak. I think it was around 181,311.
Yep, that was the top.
And since hitting that peak, the index has been making lower highs and lower lows.
Right.
It's trying to find a floor, like some level of support, in the 176,000 to 177,000 range.
Which is exactly where it's hovering now.
Yeah. But, a pattern of lower highs and lower lows, that often triggers warning bells for traders, doesn't it?
Oh, absolutely. It can signal structural weakness.
Right. So I'm wondering if this specific pattern indicates that the bulls have genuinely lost control, or if we're just looking at, a marathon runner leading against a wall to catch their breath.
That is the million-dollar question. And the key to interpreting that pattern, it lies in the volume data.
Okay.
Because a structural failure, like a true bearish reversal, would show those lower highs and lower lows accompanied by expanding, heavy volume.
So lots and lots of selling.
Aggressive distribution, yeah, where large institutional players are just actively dumping their portfolios and completely overwhelming the buyers.
But that's not what's happening here.
No. The technical report highlights that the volume trend shows moderate participation during this phase.
So the lack of panic selling is actually the most bullish signal hidden in this downtrend.
That is a great way to frame it. The moderate volume suggests a temporary withdrawal of buyers rather than an aggressive onslaught of sellers.
They're just stepping back.
Right. The market is heavy from that 18% run. It's drifting downward under its own weight, just searching for a price point where institutional algorithms and value investors feel, comfortable stepping back in.
And that floor appears to be solidifying right around that 176,000 level.
It looks that way on the macro level, yes.
Okay. But while the macro index is calmly drifting and looking for a floor, the micro level is a completely different story.
Yeah, yeah.
Because the index is an average, and averages are great at hiding individual catastrophes.
They smooth everything out.
They really do. And this brings us to the earthquake. Gandhara Tire and Rubber Company.
Ticker symbol GTYR.
Yes, GTYR, which is experiencing an absolute meltdown.
It's brutal.
It really is. So yesterday, the technical chart for this stock showed it comfortably trading inside a well-defined ascending channel.
It looked great.
It had clear mathematical support lines. It looked like a textbook predictable trade.
Right.
But today, they held their board of directors meeting.
And reality set in.
Yeah. The release of their financial results for the year ended June 30, 2026. It was just a brutal reminder that technical channels are completely irrelevant when the underlying business model is fracturing.
Yeah, and fracturing feels like an understatement when you look at these numbers.
Right. The board announced NIL dividends, no bonus shares,
Nothing for the investors.
nothing. But the headline that destroyed the chart is the profit and loss statement.
The net loss.
GTYR announced a staggering net loss of 1.01 billion rupees for the year.
$1 billion rupees.
Yeah, that translates to a loss per share of 8.26 rupees.
And the historical context makes that figure even more alarming.
How so?
Well, the previous year, they reported a loss of 366 million rupees. So the market might have priced in a continuation of that trend, right? Perhaps expecting a loss of 400 or maybe 500 million.
Sure, you expect a little worse maybe.
But seeing the losses nearly triple to over $1 billion rupees, that triggers an immediate aggressive repricing of the company's valuation.
Yeah, I dug into the income statement to understand the mechanics behind a billion rupee crater, and it's basically a two-front war for them.
Yeah, it's not just one thing going wrong.
Exactly. First, top-line revenue is shrinking. Their net sales dropped from 17.7 billion rupees down to 16.8 billion.
So they are moving less product.
Right. But the true fatal blow is the finance cost.
This is the killer.
They reported a finance cost of 1.14 billion rupees.
That is the vicious cycle of corporate debt in a high-interest environment right there.
It's terrifying.
Because when a company's finance costs, the money required purely to service their existing debt, when that surpasses $1 billion rupees while sales are simultaneously contracting, the cash flow mathematics completely break down.
Right, because there's no money coming in to pay for it.
Yeah. The company is bleeding capital just to keep the lights on, leaving absolutely nothing to reinvest in operations or weather the declining sales.
And the market's reaction was instantaneous and violent.
Oh, yeah.
The stock plummeted 9.71% in a single day, closing at 29.75.
Nearly a 10% wipeout.
Yeah. And it wasn't a quiet drop. The volume was massive, with 2.93 million shares traded.
Lots of people rushing for the exits.
Exactly. The technical chart shows the price slicing straight down through the bottom of that ascending channel, just completely ignoring the immediate support line at 31.05.
It didn't even pause.
Right. And the relative strength index, the RSI, it plunged to 28.18.
Yeah, an RSI dropping into the 20s, that reflects extreme indiscriminate selling.
It's just pure panic.
Exactly. The institutional algorithms that were programmed to buy the stock at the 31.05 support line, they were likely overridden the second that earnings report hit the wire.
Right. The computer says, wait, things have changed.
The fundamental news acted as a circuit breaker, just canceling all the historical technical assumptions.
And this scenario is so fascinating because it pits the chart geeks against the spreadsheet analysts in real time.
It really does.
Like, we have a stock that is technically deeply oversold, meaning the chart is screaming that it's historically cheap.
Right.
The report notes the next floor support is at 28.74. I can totally imagine day traders looking at an RSI of 28 and thinking, hey, this is a prime opportunity to buy the panic and ride a quick bounce upward.
I mean, they probably are, but buying into that scenario requires assuming that the underlying value of the company hasn't changed.
Right.
That only the current market sentiment has changed.
But the fundamentals did change.
Exactly. The fundamental data proves the intrinsic value of the company is rapidly eroding.
Yeah.
A $1 billion rupee loss fundamentally alters the company's book value and its survivability.
So even if it bounces,
It's risky.
highly.
Right.
While you might see a brief technical bounce at the 28.74 level simply because the downward momentum mathematically exhausts itself temporarily, stepping in as a long-term investor right now is incredibly dangerous. It's catching a falling knife.
Exactly. The technical lines are secondary until the balance sheet stabilizes.
That makes perfect sense. The fundamental reality dictates the long-term trend. while the technicals just show the short-term panic.
Precisely.
Now, the contrast to GTYR in our sources is stunning.
It's like night and day.
It really is. If the tire sector is an example of fundamentals annihilating a technical chart, the cement sector is currently operating like a masterclass in market mechanics.
Yeah, the charts here are just so mathematically precise, they look almost fabricated.
They do.
The cement sector right now is a prime study in algorithmic and institutional order flow.
Okay.
When the underlying fundamentals are stable or optimistic, the technical lines dictate the flow of capital with incredible accuracy.
Well, we have 3 specific cement stocks highlighted in the report, starting with DGKC Cement, DGKC.
Right.
It closed at 219.50. The technical analysis describes it as trading inside a beautifully structured ascending channel.
It's a very clean chart.
Extremely clean. In mid-July, the price dipped to 202.42, hit the absolute bottom boundary of this channel, and bounced perfectly.
Perfect touch.
Yeah, and now its RSI is sitting at a healthy 60.22, showing rising bullish momentum, and it's targeting resistance at the 224 level.
And that mid-July bounce at 202.42, that is the footprint of heavy institutional capital.
What do you mean by footprint?
Well, when a price touches a diagonal trend line and immediately reverses upward, it tells you that major buyers have calculated that specific price point as fair value.
Oh, I see.
They stack their limit orders right on that line, basically creating an invisible wall of liquidity.
So it can't drop past it.
Right. Every time the price gets cheap enough to touch the line, those orders execute, absorbing any selling pressure and driving the price back up the channel.
Wow. And I see the exact same footprint on Maple Leaf Cement MLCS.
Yes.
It closed at 102.0, up 1.75% for the day. But the detail that really stands out here is the volume.
It's massive.
5.36 million shares traded.
Yeah.
The chart shows it bouncing with incredible resilience right off its 100.35 support level. And it's now poised to test the 103.96 ceiling.
And to put that volume into perspective, 5.36 million shares trading at roughly 102 rupees a share, that means over 500 million rupees moved through that stock in a single day.
500 million.
Yeah. Retail traders do not generate 500 million rupees of volume on a Tuesday.
No, definitely not.
That is institutional accumulation.
Okay.
The heavy volume right at the support level indicates that large funds are actively defending that price, adding to their positions.
So unlike the panic volume we saw in GTYR, this is pure conviction buying.
Conviction is the perfect word for it.
But the chart that really caught my attention, the one that looks like a high wire act, is Lucky Cement. L-U-C-K.
Oh, the Lucky Cement chart is tense.
It really is. It closed at 440.02. The price corrected down from 470, and it's now sitting exactly on a major multi-month ascending trend line that originated back in May.
Right on the line.
Yeah, the current price is 440.02, and the major support convergence on the chart is calculated at 438.24.
It's incredibly tight.
It feels like watching a tightrope walker balancing a few inches above a highly tensioned safety net.
It does. And the term for that safety net in technical analysis is confluence.
Confluence.
Yeah, and it is one of the most powerful concepts in chart reading.
How does it work?
So confluence occurs when multiple independent technical indicators intersect at the exact same price point, creating a high probability zone of action.
So break down the specific confluence happening at that 438 level for Lucky Cement.
Sure. With Lucky Cement, you have 2 distinct psychological barriers meeting.
Okay.
First, you have a horizontal support level near 438, which is a historical price floor where buyers have previously stepped in.
Right.
Simultaneously, you have the diagonal ascending trend line from May rising up to intersect that exact same 438 level today.
I see.
So traders who rely on horizontal levels are placing their buy orders there, and algorithmic systems that trade trend lines are placing their orders there.
So they are stacking their capital on top of each other, reinforcing the floor.
Exactly. It creates a massive concentration of buy orders.
Wow.
And if that 438.24 level holds and the price bounces, it is a violent confirmation that the long-term upward trend remains dominant.
Meaning the bulls retain absolute control.
Yes.
But the tension comes from the alternative, right?
Always.
Because the data shows that if the 438 level snaps, if the selling pressure somehow overwhelms all those stacked buy orders, the next safety net isn't until 422.28.
Which is a long way down.
That is a massive void.
It's a liquidity vacuum.
Right.
When a point of heavy confluence breaks, it doesn't just mean the buyer's lost. It means a wave of automatic stop-loss orders is about to trigger.
Oh, because everyone who bought there put their stop loss right below it.
Exactly. Every institution and trader who bought at 438 placed their emergency exit, their stop-loss, just below that line.
Yeah.
So if the price drops to 437, all those sell orders fire simultaneously into a market that suddenly has no buyers.
Which causes the price to cascade rapidly down to that 422 level.
Exactly. The tension on this chart is palpable because the outcome will be explosive in either direction.
And that transition from perfect trends to explosive tension, it leads us perfectly into the final category from our sources.
Right. The paused stocks.
Yeah. We've seen fundamental destruction. We've seen algorithmic perfection. Now, I want to look at stocks that are currently pausing, kind of acting like compressed springs, waiting to release stored energy.
The consolidation phase.
Yes.
It is often the most overlooked part of the market cycle by retail investors, but it's also where the most lucrative setups are formed.
Really? Let's start with Pakistan State Oil, PSO.
Okay.
It's currently trading at 374.4 a year. The technical report shows it had a powerful gap up in early August, shooting up to 390.20.
Big move.
Yeah, but since that peak, it's been drifting sideways and slightly downward. The analysis identifies this as a bullish flag pattern,
Right.
and it calls it a healthy cool down, assuming it holds support around 374.41.
Yeah. A bullish flag is essentially the visual representation of market absorption.
Market absorption.
Yeah, so the initial surge to 390 was driven by aggressive buying. Eventually, those early buyers want to lock in their profits, so they start selling.
Makes sense.
Now, in a weak stock, that selling would cause the price to collapse right back to where it started.
Right.
But in a strong stock, new buyers step in to absorb those shares.
Okay, so the price drifts downward slightly, forming that flag shape, but the underlying demand keeps it elevated.
Exactly. It is a transfer of shares from impatient hands to patient hands, basically building energy for the next upward leg.
The mechanics of that make total sense. It's a healthy rest.
Yeah.
But the setup that genuinely surprised me is TPL Corp.
Oh, yeah.
Because the math on this chart seems stretched to an extreme limit.
It is.
So TPL Corp is trading at 22.24. The report notes it is in a medium-term uptrend, but is pulled back to short-term support.
Right.
But the flashing red light on this chart is the stock RSI indicator, which is reading 7.11 over 9.74.
Both under 10.
Both of those numbers are under 10. To my mind, that sounds like a rubber band pulled back. So far, the rubber is starting to tear.
The rubber band analogy is incredibly accurate for stock RSI.
Okay, good. Because standard RSI, it measures momentum to tell you if a stock is overbought or oversold, right?
Right, but stock RSI, the Stochastic Relative Strength Index, it applies a secondary mathematical formula to the RSI itself.
Okay.
It basically measures the momentum of the momentum.
So it is hypersensitive to changes in buying and selling pressure.
Highly sensitive. And it operates on a scale of 0 to 100. Generally, any reading below 20 indicates the asset is deeply oversold.
Meaning the downward price action has been relentless.
Right. And the mathematical probability of a reversal is extremely high.
Right.
For TPL Corp to register a stock RSI of 7.11, that means the selling momentum has mathematically exhausted itself.
The sellers have essentially run out of inventory to dump on the market.
Yes, the selling pressure is drained. The report concludes that a technical bounce right off its immediate support of 22.08 is highly probable simply because that downward force has vanished.
So any slight influx of buying volume will cause that stretched rubber band to snap violently upward.
Precisely.
I follow the logic there. Deep exhaustion leads to a sharp bounce.
Yeah.
But I have to push back on the next stock in the TPL family. TPL Properties, ticker TPLP,
Okay, lay out on me.
is trading at 14.58. The report states that after a surge in late July, it has been stuck in a tight horizontal consolidation range, just ping-ponging back and forth between 14.20 and 15.00.
Right.
The RSI is sitting right in the middle at 47.13.
Dead center.
Yeah. So I look at a chart like this, a stock that has just been dead money for weeks, and I question why we are even analyzing it.
It looks boring.
It does. Tying up capital in a stock moving sideways feels like a massive opportunity cost when there are active trends elsewhere.
Right, but that frustration you are feeling, that is exactly the psychological mechanism the smart money relies on. Oh yeah. When a stock trades in a tight horizontal range for an extended period, it is not dead money. It is in a phase of accumulation.
Elaborate on that, because on the surface, it just looks boring.
Well, the market operates on the transfer of liquidity, right?
Sure.
In a tight range like 14.20 to 15.0, Large institutional players are quietly building massive positions.
Oh, I see.
They buy near the 14.20 floor, but they are careful not to buy too much at once, which would spike the price.
Because they want to keep getting it cheap.
Right. They need the price to stay suppressed while they accumulate.
Wow.
Meanwhile, retail traders who thrive on volatility and excitement, they look at the sideways chart, get incredibly bored, and sell their shares to chase the momentum of a stock like PSO or DGKC.
Oh, wow. So they willingly hand their shares over to the institutions just to find some action elsewhere.
Exactly. Over time, the floating supply of shares available in the open market just dries up. The institutions absorb it all.
Okay, that makes sense.
This tight horizontal channel is storing immense market energy. The second that TPLP breaks through that 15.0 ceiling with strong volume, it signifies the accumulation phase is over.
The institutions stop suppressing the price
Right.
and just let it run.
And the retail traders who sold out of boredom suddenly rush back in at a higher price, which provides the fuel for a massive rally.
That is wild. Watching the boring charts is how you position yourself before the explosion happens.
Exactly.
That completely reorients how I view a sideways chart. It's not dead, it's just quietly loading.
Building the spring, yeah.
So synthesizing all of this data provides a phenomenal picture of the KSE-100 right now.
It really does.
We started with the macro view, seeing the index as a whole, digesting its massive 18% yearly gain, calmly finding a floor around 176,000.
Right.
But diving into the individual source documents revealed a landscape of extreme contrast.
Because the friction between the macro average and the micro realities is always where the true narrative lives.
Yeah, I mean, we watched a billion-rupee fundamental loss from GTYR act like a wrecking ball,
Complete devastation.
instantly destroying a mathematically sound technical chart and forcing a violent repricing.
Right.
And then we analyzed the algorithmic precision of the cement sector, tracking ₹500 million of institutional flow into MLCF,
Beautiful chart.
and the high wire tension of Lucky Cement's confluence at 438.24.
Yeah.
And finally, we decoded the hidden energy in the market, from the mathematically exhausted sellers in TPL Corp to the quiet psychological accumulation phase of TPL properties.
It's a lot to take in, but I think the overarching lesson from combining these specific reports is recognizing the hierarchy of market data,
And how they stack up against each other.
Exactly. Technical analysis maps the psychology of the crowd. It reveals where capital is gathering and where fear is hiding.
But a chart is only a reflection of the past.
Right. Fundamental reality is the engine of the future. When fundamentals remain steady, the technical map is incredibly reliable.
But when fundamentals shift,
The map burns.
wow. That leaves us with a truly compelling dynamic to consider as we close out this analysis of the August 24 market.
We have certainly seen the evidence of both forces at play today.
We certainly have.
Yeah. I mean, we watched today how a singular piece of hard fundamental data, GTYR's staggering 1.01 billion rupee loss, could just instantly obliterate a historically reliable technical chart.
Right, transforming a safe technical channel into a cascading panic.
And it forces us to look differently at the rest of the market.
How so?
Well, as we observe the textbook perfect, algorithmically defended ascending channels in the cement sector today, with their precise bounces and massive institutional volumes, we kind of have to ask a darker question.
Okay, what is it?
What happens to those mathematically perfect lines if a sudden, unexpected macroeconomic shock hits the entire country tomorrow?
Oh, wow.
Are these pristine charts genuinely predicting a prosperous future, or are they just perfectly measuring the silence before a storm?